Well, good morning. It's me, ｃｈě̌polical, and today I'm coming to you live from North Palm Beach. And look at this. Look at the clouds above me, right? They're kind of dark and gray and ominous. The wind is blowing. It's not a super sunny, warm day. It's about 65 here, but I wonder if those clouds are suggesting today's action. So let's get on to it. Today is Wednesday, December 20th, and I am your host of the party, ｃｈě̌polical, and here's what you need to know. Yes. Stocks went up again yesterday, right? This is getting to be a broken record. All as bond yields continue to do the Fed's work. And oil, well, that's back kissing the resistance trend line up at $75 as the Hooties, right, that Iranian terrorist organization, continues to cause disruption in the Red Sea and the Suez Canal. I think it's about time to straighten that out. And what do we have for dinner tonight? Well, this is a Christmas Day classic. And it's a classic Bolognese sauce served either over raviolis or rigatoni or any kind of pasta that you like. So let's talk about it. Stocks went higher on Tuesday as the rally gets increasingly long in the tooth, right? Gains were broad across all 11 sectors as the S&P was up once again as growing optimism continues to push stocks higher. Not a single one of them taking a breath, taking a moment to breathe. As the bell rang, we saw the Dow gain another 252 points or 7/10. The S&P was up 28 points or 6/10. The Nasdaq up 99 points or 6/10. The Russell taking the lead up 39 points or nearly 2%. The Transport's gaining 142 points or 9/10, while the equal weighted S&P rose 55 points. Each of these sectors now solidly in the green for the year. The Nasdaq way out in front, up 44% year to date, with the equal weight S&P taking up the rear at up 11%. All of the others are settled nicely in between. Energy, the XLE, right, was the clear winner on the day, up 1.2%. Communications up 1%. Basic materials up 9/10. Consumer discretionary up 8/10. Industrials, financials, and real estate and healthcare all up 7/10%, while utilities were up 6/10%. Tech was up 4/10%, and consumer staples adding just 0.2%. Now, if you dive a bit deeper, once again, we had the home builders, right? The XHP up 1.4%. You could think about it, that incredibly strong housing starts report that showed housing starts up a whopping 14.8%. Just think about all those appliances, the sinks, the toilets, the siding, the flooring, the lighting, the windows, the pools, the concrete, the lumber, the copper, the plastics, the hot water heaters, the AC units, and the heating units, right? You get the picture, don't you? Now, disruptive tech, Cathie Woods' ARK gained 4%. Retail, XRT, up 2.4%. Think of the strong, robust economy that needs zero stimulation. Airlines up 1.2%. Think about experiences over gifts. XME, the metals and miners, up 3%. Artificial intelligence, C3.ai, up 5.5%. Aerospace and defense, up 1.5%. Oil and gas exploration, up 1.2%, while the semis and the cyber rose 0.5% and 0.7%, respectively. So now what? Well, as the Wall Street Journal points out, the decline in inflation is making it very difficult for JJ and the Fed. And why is that? Because every time any one of them opens their mouth, all the algos hear is that the Fed is about to cut rates. No matter what the language is, no matter what they say and who says it, if they say don't go betting the ranch that rate cuts are imminent, the algos here, I'm betting the ranch because rate cuts are imminent. And this could not be more obvious than in the past week after that final FOMC meeting of the year. Yes. Did JJ change the language in the press conference? Yes, he did, which was, I think, the first problem. In fact, I think he went off script, and then he couldn't pull it back, right? Because he went too far off script, and so they kept backing him into a corner, right? Acknowledging the fact that the dot plot was suggesting 3 cuts. But remember, the dot plot is not policy. It's just what members, anonymously, by the way, think might happen in the future. It does nothing to suggest that it will happen. But when JJ went on to say, when he was pressed, that they're now talking about cuts in 2024 versus in the November meeting, he said that they were not only not talking about it, they weren't even on the table. Right? It wasn't an option. And then the rest is history from there, because we know what happens, right? The algos went into overdrive, taking the markets up another 3% on top of the 12% gains that they've already had since the late October lows. So when JJ realized how his comments were being interpreted, right, with the estimates now suggesting some 5 and 6 cuts next year by the Fed, by the way, he sent out the troops. New York's Johnny Williams saying that, slow down, it's not really what he meant. We're not really talking about cuts. And then Cleveland's Loretta Mester reiterated it. Then Atlanta's Rafi Bostic repeated it. But the algos tuned them all out, taking stocks higher and higher and higher. And then San Fran's Mary Daly, of all people, came out of hiding and offered her analysis, saying that rates were going lower, and that's what the algos focused on, right? Which is amazing to me, that the algos are going to listen to the woman who failed the regional banking industry in spectacular fashion, right? Recall that it was under Mary Daly's watch that sent the regional banking industry and the markets into a tailspin in February when Silicon Valley Bank failed because of the lack of proper oversight. Now, I'm not saying that management at SVB weren't a bunch of idiots, because they were, but Mary was the regulator that should have caught that. Let's not go there right now. Why? Because it's Christmas and I don't want to go there, neither do you. But it was Mary, and the buck has to stop somewhere. So it was Mary that caused the Fed and the Treasury to launch more emergency funding programs to backstop every single depositor in the country to prevent a repeat of the great financial crisis. And that's the person that the market is listening to. I mean, to me, that's amazing that, they're giving her that much credence. But whatever, it is what it is. Look, JJ said that he won't get inflation down to that 2% target until sometime in late 2025 into 2026, if they even get it to that target, which means we have at least 2 more years of grinding higher inflation. He also said that unemployment remains at historic lows and that the consumer is strong and that by all accounts we've avoided a crash landing. So then what am I missing? Tell me again why exactly the Fed needs to cut rates at all. Tell me again why we need to stimulate the economy by cutting rates. Tell me why higher for longer suddenly turned into higher for shorter. Tell me again why 5.25% Fed fund rates is not normal. Because for most of us in the baby boom generation, that is more than normal. And remember, cutting rates is not going to cause all those revolving credit card debt interest rates to see any revision to the usurious 30% rates, right? It's not going to bring food prices down. It's not going to bring housing costs down. In fact, it's going to do the opposite. It will bring government funding costs down though a little bit, and it's going to offer some relief to all those commercial real estate refinancings that are due next year and the year beyond. But it will also have the ability to reignite inflation, and that's going to hit you, the average American, right in the pocketbook. And so why all the fuss anyway? I mean, when you think about it, the Treasury market is doing so much of that work already. The 10-year, which was yielding 5% only 6 weeks ago, is now yielding 3.88%. Mortgage rates that were 8%, 6 weeks ago, are now 7% for 30-year conventional money, and if you're in the low sixes for a 5/1 ARM, right? And lower even if you have a FICO score better than 740. The 3-month is now yielding 5.19%. That's down from 5.5. The 6-month is yielding 5.07. That's down from 5.55. The 2 years at 4.37, down from 5.25. Do I need to go on? Rates are down 22% on the 10-year over 6 weeks. That looks like a rate cut to me. I don't know about you. Now, the TLT, which is the 20-year bond ETF, has rallied 20% in those 6 weeks, leaving it just down 0.6% on the year. Remember, it was down nearly 20% versus the 20% just 6 weeks ago. The TLH, which is the 10 to 20-year bond ETF, is up 15% during the same time, leaving it also down only 0.6% year to date. And the massive rally in the bond market supports lower yields, which is essentially lower rates. So stop the whining about lower rates because you already got them. But what is interesting is that the other day there was a headline that said 40% of student loan payments, the ones that were given a free pass when COVID hit, that 40% of them were in default. The headline suggesting that people couldn't pay because they were stressed out that inflation was eating away at their ability to live. Well, I would argue the opposite. I would argue that they aren't paying them because they expect them to be forgiven. So why make the payment in the first place? Just spend the money somewhere else and then say, oh, I'm so stressed I can't make the payment, because they expect that the Democrats and Joe Biden are ultimately going to forgive the student loan. Anyway, that's a whole nother story. Eco data today includes existing home sales, which are expected to be lower, and mortgage apps. In addition, we're going to get the Consumer Board Consumer Confidence Survey numbers. Tomorrow is going to bring us the GDP, right? Core PCE and the Philly Fed Business Outlook. Friday is going to bring us the even more important, the PCE deflator and the personal income and real personal spending accounts. And so all eyes, whoever's left sitting at their desk on Friday, ahead of the long holiday weekend, will be paying attention to the PC. But you can bet the algos will be paying attention. Remember, most of the data comes out on Thursday and Friday, which is right before the Christmas celebration. Now, and remember that the next 2 Mondays are holidays, right? So we got 2 shortened weeks. So a lot of the people are not in their office towards the end of this week. So expect the algos to take control, which just means we could see exaggerated moves in either direction, depending on what the algos' interpretations are of the data, which also means that asset managers and portfolio managers will have put good till cancel orders either above the market or below the market in order to take advantage of those exaggerated moves should they happen while they're away from their desks, right? So should the data suggest that the algos create these exaggerated moves one way or the other, then they'll make sales if the market takes off, and they'll make purchases if the market retreats. Now, I continue to suggest that you stay the course. The market has had a significant move up. Yes, you are invested, so you're participating. You haven't missed it. You're going along, so don't have any fear of missing out, right? That's if you followed what I've been telling you over the last couple of months. Now, consider taking new money and just for the time putting it in short-term treasuries, right? Think 3 months at 5%, just until we move into the new year, right? Let's see how this shakes out a little bit, because it's going to shake out. 3 months, you're going to get 5% on your money for a percentage of your portfolio isn't anything to sneeze at, right? It allows you to sleep at night, and it gives you some time to consider what's happening. My fear is that the sharp rally that we've seen is just setting us up for some disappointment, at least in the early part of 2024. So staying vigilant is not a mistake. Now, what happens if Johnny Loretta, Rafi, Austin Goolsby, and others are right? What if it is premature to be talking about rate cuts? Markets will adjust, right? Things are going to move down. Just something to consider. Not something to make you completely change your plan. Absolutely not. Which is why I'm saying put new money into the short duration assets just for a while, 3 months, even go 6 months. But I think 3 months is better. Just gives you a little bit more flexibility. Now, U.S. futures this morning were down, right? It's not a typo. They were down. Just a bit lower, nothing dramatic. Dow futures were down 50, S&P's down 8, Nasdaq was down 45, the Russell was down 3. Oil is up again, now trading at $75 a barrel on the ongoing unrest in the Red Sea and the Suez Canal, caused by no one other than the Hooties, right? Supported by none other than the Iranians. This not only continues to raise concerns about supply, but also about other geopolitical unrest, which is why I like the names of aerospace and defense, right? Raytheon's up 20% in 6 weeks. LMT's up 14% in 6 weeks. General Dynamic up 18% in 6 weeks, right? That's aerospace and defense stocks. We're only 50 cents away from the oil trend line at 75.60. A move up and through could see us retest $80 a barrel. A failure to break out, though, could see us push lower and retest kind of the low 70 level. Gold remains in the tight trading range, 2030, 2050, and unless something drastic happens, I don't see it doing anything dramatic for now. European markets are marching lower. Desks are starting to empty out. The UK inflation is down, but still running at 3.9% annually. But traders there are pounding on the door of the Bank of England, demanding rate cuts in 2024. This after the Bank of England left rates unchanged and told them that rates need to be more restrictive for an extended period of time. But those demands are helping the UK market go higher, and that market is up 0.6%. The other markets are a little bit lower. The S&P closed last night at 47.68, up 28 points as the euphoria continues. This morning, though, it feels a bit weaker, but don't discount the fact that the offices are starting to empty out. People are away from their desks, right? And the desks are now being run by the algos and artificial intelligence. FedEx this morning, the big name of the day, is down 11% after reporting an earnings miss and lowering full-year outlook. Well, don't go holding a charity event. FedEx is still up 50% year-to-date after the 11% hit. And all this goes to show you is exactly how swiftly the tone changes and how swiftly stocks can reprice if investors and algos do not hear what they want to hear. I mean, yesterday they were happy to pay $280 a share for FedEx. Today, they're screaming about paying $250 a share, which brings it right back to the trend line. Now, let's just see if it holds the trend line. Earnings season, remember, is now only 4 weeks away. Capiche? Now, remember, I said it. If you're invested, you're good. If you have more money to put to work, be patient. Don't go chasing anything. Put it in short duration. Let it come to you. Remember, it's time in the market and not timing the market. Call me to discuss because I'm always happy to talk to you about it. 212-381-6194. Okay, so now what are we having for dinner? This is a classic Christmas Day dish, right? It's just a simple bolognese, but it's a classic bolognese. But you make it with either raviolis or manigattis or rigatoni, something substantial, right? So what is bolognese sauce? It's a meat-based, thick, hearty sauce for that you're going to use with your pasta. It's originated in the town of Bologna. Bologna is the largest city in the region of Emilia-Romagna in northern Italy, and it is the 7th largest city in all of Italy. It's a very cosmopolitan city, rich in art, history, music, culture, and food, and it's home to many of Italy's finest universities, right? This particular sauce has numerous variations, but no matter how you make it, you can hardly go wrong with it, right? Now, for this, you're going to need either equal parts of ground beef, veal, and pork, or any combination thereof that you like. Maybe you don't like the pork, so you just use the veal and the beef. Maybe you just use the beef, whatever. You need 2 large cans of plum tomatoes. You need fresh basil, whole milk, olive oil, white wine, you know me, Pinot Grigio, Santa Margherita. You need nutmeg, salt and pepper, onions, carrots, celery, and garlic. Begin by sauteing the sliced garlic in some olive oil over medium-high heat. Then add in the sliced onions, the carrots, and the celery. Stir it, cover it, allow it to kind of cook through and soften up a little bit. Stirring every 5 minutes or so. Let it cook in there for 10-15 minutes, whatever. Once the veggies have softened, now you're going to add in the meat. Whatever meat you choose, you're going to add in the meat. Break it up with the wooden spoon. Brown it all nicely. Season it with salt and pepper. Once it's all brown, you're going to add 1 cup of the white wine. Again, the Pinot Grigio Santa Margherita. You're going to allow it to simmer away. Mix it well, then allow it to simmer away completely. After that's evaporated, you're going to add 1 cup of whole milk, allowing that to absorb and also simmer away. Keep it on low, right? Now you're going to add a shake of nutmeg, not a lot. Now, while this is happening, take your plum tomatoes, run them through the blender quickly. You want to leave them a little bit chunky. You don't want to really liquefy them, right? Now, when the milk is all evaporated, and your tomatoes are ready. Remember, you want to put enough tomatoes in this to make a sauce, but you want to keep it hearty. You don't want it to be too saucy, right? You're going to add in the tomatoes to the meat, and then you're going to add in the chopped basil. You're going to season it again with salt and pepper. You're going to bring it up to a boil, and then turn it down to simmer. Let it simmer for about 45 minutes, stirring it occasionally. You want to taste it and adjust it as necessary. While this is happening, when this is done, you're going to bring a pot of salted water to a rolling boil. If you're having rigatoni or another pasta like that, otherwise you're going to take your raviolis, your manigattis, whatever you're going to make. Now, when the pasta is done, before straining, take a mug full of the pasta water out, strain the pasta, put the pasta back in the pot. Add a little bit of the pasta water, 1/4 cup maybe, back in just to stir it to allow the pasta to reabsorb some of the water, right? Don't make a puddle on the bottom of the pan. Once that's all done, take 2 or 3 ladles of the bolognese sauce, put it right in the pot with the rigatoni, stir it up, add some fresh grated Parmigiana cheese, mix it in. Now you're going to serve this in warm bowls. You're going to put a ladle of the bolognese sauce right on top. You're going to put sprinkle a little bit of extra Parmigiana cheese on it, and then you're going to serve it to your guests. But remember, you're always, always, always going to have more Parmigiana cheese on your table for your guests, because in my mind, you can never have enough fresh grated Parmigiana cheese for the pasta. In any event, look, is it a beautiful day here in South Florida? It's not. The weather's nice, and it's warm out, 68 degrees right about now. But it looks a little bit stormy up above, and so I wonder if that's going to be indicative of what's going to happen in the market today. In any event, until tomorrow, take good care.